A lot of people have been asking me, why am I here? I'm here because we are amongst very good friends, very good partners, and some even almost family. Part of the SGX family, Ching, thank you for the support. Terence has been a long supporter of our market. And actually, maybe we should have done it here. Don't need to pay rent. Come to SGX, we do the IPO ceremony. So it really gives me great pleasure to say a few words at the official launch of the Azure Capital's Special Situations Fund, which I understand is currently a 100 million fund focused on small to mid-cap markets. I believe that will grow significantly. I would like to highlight two structural trends going on globally in the financial landscape, which I believe will favor small to mid-cap funds such as Azure. The first, many of you already know, is the trend of passive index investing. It's a bit boring, but it actually gathers a lot of money, and a lot of money is just chasing the beta of indices. So what then happens is that if you're not in the index, you may be actually mispriced, underpriced, because lazy money is just following an index. Some of you may know, they say London is a very big market, but if you're not in the FTSE 100, you only share the balance 15% of the market liquidity. Australia and Thailand, similarly, if you're not in the ASX 200 or you're not in the SET 50, you only share less than 10% of the market liquidity. So the trend towards passive investing has actually been going on for the last few years, gathering a lot of assets, giving a lot of momentum to companies and stocks that are part of the benchmark indices. That's why the STI, comparatively, the P ratios are still higher than even HSI. Go check it if those of you don't believe. Right? But that being said, this trend, I have reason to believe, will start to come to an end. Because if everybody, all the managers just hug the index, they will not be differentiated. So while last year, active managers lost money, outflows, perhaps the darkest hours before dawn, I believe that the market over time will start to differentiate, and when it starts to differentiate, the opportunities in the small to mid-cap space could be significant. The second change that's going on globally is really regulatory in nature. And no, this is not caused by SGX. It's called MiFID II. Unbundling research and broker coverage that only the largest and the most liquid stocks will get covered by the large investment banks and the houses, because this regulatory change impacts all of them globally, and again, it will divert attention from the smaller and the mid-cap stocks. So it's a real challenge that we do see that the small to mid-cap market over time continues to face increasingly less research coverage, and by virtue of that fact, would be potentially underappreciated by investors. So the likely outcome, obviously, is increased mispricing. What does that mean? Oh, the market is undervalued? No. What mispricing actually means is that there will be opportunity. The market globally, and in the Singapore market in particular, has got a lot of opportunity. Mispricing creates opportunity for specialist investors to uncover gems with discounted values, and gems that will grow to become champions over time. Talking about specialists in this segment, I cannot think of many with the pedigree and the sterling track record of Terence. Consistently recognized as one of the industry's top research analysts throughout his career, Terence is a veritable source of deep insights into the SGX small to mid-cap segment. He knows more about the market than me, obviously. His track record on picking winners speaks for himself. As I'm sure many here today would have first-hand knowledge of his success. I wish Terence and Azure Capital all the very best, and I hope that the fund will help to uncover many more success stories in the Singapore market, and will help investors channel the growth capital to these companies and create new successes from all the opportunities that abound. So without further ado, I'll hand the mic over to Terence. Thank you.
Thanks so much, Sutat. Wow, very, very kind words indeed. I'd like to welcome everybody here once again. Sutat's speech was very forward-looking, and it is very apt for an official launch. But I would like to take an opposite track. I yearn for the days when I first started my career. That year was 1999, and we bore witness to articles like this. This is a Business Times article. It's not made up. It's not fake news. Singapore ranked #1 in access to capital in Asia. In particular, it says Singapore has deep capital markets as demonstrated by the size of both the equity market and banking sector. Wow. I know some of my younger friends will go, sure or not? Where got like that? Singapore #1 in terms of equity? Definitely. And that was during my time. And in year 2000, in my first full year as an analyst, I was just telling my colleagues yesterday, there were 76 IPOs. 76 IPOs in a single year. And I was responsible. I wrote for 59 IPO notes. I still remember vividly during that period of time. It was amazing. But over the last few years, I can understand the pain a lot of investors go through. They will argue that, hey, Singapore cannot make it lah. You know, there's no action at all. If you look at the average value traded a day, in 2010, $1.6 billion. Last year, a paltry $1.08 billion. That's a 32% decline. So I can understand. That is boring. Singapore only got REITs to buy. What else? Value trap. Some more. This stock's very good. 5 times PE. Next year, lagi worse. 3 times PE. So we all feel the pain. But I've been saying year in, year out, Singapore, if we want to be a global financial center, we cannot have a third-rate stock market. So there are things that we need to do. The ingredients are basically in place. This I am very, very confident of. Fundamentals, valuations, corporate governance, support from government is all there. We just need to have confidence and we need to have champions. And I'm willing to be that champion because I think, you know, if we all put our weights together, we can make a difference and we can make money. And I know the last quarter has been fantastic for the markets. So a lot of people are happy. They say, you know, it's good days again. You know, and I don't know why you're saying this, but for me, I've been consistently singing the same tune. When I retired as a research analyst, I told the media, like Kenneth interviewed me and said, hey, why do you retire? I said, I am going into fund management because I think I can make a difference. And what are you looking at? I am looking at the ASEAN markets, but I will want to concentrate on Singapore because, you know, it has underperformed the region the last 5 years and the valuations look very, very sweet. I believe I can outperform. Last year, during my soft launch, I met up with ST, BT, Zaobao, as well as The Edge. And I said this Hao Xiang's article. I have this wish, this ambition to push the Singapore market. I really said that. Hao Lian, this guy. I wish this ambition to push the Singapore market. Given that I know the different constituencies of the stock market, I feel confident that I can do something. And I can make the best returns in Singapore out of the whole region, the whole universe that I have in ASEAN. I believe I can make the best returns in Singapore. So with that, I started the fund. That was a soft launch. We kicked it off. And maybe for the uninitiated, I'm going to talk a little bit about what I do. Azure Special Situations Fund, which is under the Azure Capital umbrella, we source for unique ideas with catalysts between 6 and 12 months. Absolute return, so we don't really care about the markets. Markets can go down, markets can go up, but I will try my best to actually eke out the best returns for investors. Very, very research-driven, and that's because I have been in research for the last 16, 17 years, and I believe very much in fundamentals. And I like the small caps. You know, I made a living as an analyst for many, many years, looking at the small mid-cap markets. I find so many winners, potential winners out there, and this is where I think I can get and garner the best returns. My strategy was special sits, privatization, M&A. There were loads last year. I know Kevin has a question on it. I'll answer later on. Turnaround situations. I love turnaround situations because this is something you cannot gather from Bloomberg. You do a screen on Bloomberg, and then you want to go, below 5 times PE la, above 8% yield la, 0.5 times price to book, below 0.5 times price to book. So the important thing is you need to know the management. For me, I know about over 400 listed companies in Singapore. So, and every week I try to meet up with 8 to 10 companies and to gather what they're doing. And in doing so, I understand when there's a turnaround story. Because if there's a turnaround story, the profits may be measly. We're talking about 200,000. So the PE will seem astronomical. 100 times, 200 times. So when you do a screen on Bloomberg, you will never, ever discover all these jewels. You got to speak to the management. And then you see the quarterly results start to pop up. And pop up, it can go back to normal, And normal may mean $2 million. And then suddenly your P collapses to 5 times. That, one of my favorites. Then a lot of ignored and unloved stocks out there. So together, if you look privatization plays, turnaround plays, and ignored, unloved stocks, there are tons. I would say that 60-70% of the market is made out of that. And I think my true value proposition is to unlock traps. Remember earlier on I said, hey, Singapore is a value trap. You invest many, many years, it is still 5 times PE. But for me, I'm not one that is an activist manager like some of the, I think, recent fund managers. I'm not activist, but I'm very, very active. I don't sit on my hands. I'll go out, speak to the management and see how I can help them. There are gaps. Communication, branding, tie-ups with partners. I believe in transforming through, mutual understanding. And at this juncture, I'd like to share with you some of 3 of my core anchor investors. First is Eric Lo Si Ching. Eric. I knew him in 2012 while covering Hafari. I was then in DMG. But actually, our paths crossed must have been at least 1,000 times. And I mean literally 1,000 times. Because we found out that we were schoolmates in Chinese High. 2 of us, and we were next class some more. So we shared the same toilet. It's like this Chinese show, 向左走,向右走. Minus the romantic part. So, but before I started the fund, I spoke extensively to him, and he was the first guy that gave me the confidence to step out. So I'm really, really thankful to that. And then another key anchor investor is Mr. Ching Chia Kwong. Both of them are partners at Oxley. I knew him in August 2014 when I brought him to market in Tokyo together with Kong. Kong, are you around? I think he's somewhere around, yes, in Tokyo. And at that point in time, I think many people knows his story. It's very, very well told. Left the police force, then became a serial entrepreneur. I think he sold otah, zi cha, clean drains, became a contractor, then he made his mark in developing. I think I really got to know him very well, and I really appreciated his character. That was when we went into a project together in September 2015. We were embedded in it for quite a while. And at that point in time, we didn't see a way out. But, we trudged on, and then in the end, we managed to make some money out of it. It was small on profits, but very big on life stories. And my third anchor investor is Mr. David Teo and family. Everybody knows David, he just sold off Super, and he basically transformed the way Singaporeans drank coffee. Not only Singaporeans, but people in the entire region. From Singapore, Malaysia, Thailand, and Myanmar, where he's number 1. I know amongst the family, I know Darren the longest. At that point in time, I think I knew him before he graduated from university. We are not friends back then. We were not university friends. He's much younger than me. But when he came out, I realized that, he started work doing investor relations within Super, and he managed to get, I think it is through sincerity, and he called a spade a spade. Times are good, he tells us. Times are bad, he retracts. And I think a lot of investors are very, very comfortable with that. When he first started the job, I think there was zero coverage. At the peak in 2014, there were 9 companies, including some of the biggest international firms that covered Super. Elaine, she's the branding maestro, and she, in 2013, did the rebranding exercise for Super and brought us the tagline, "What a smile tastes like." So I think collectively, we are very much anchored in this project. They have given me the commitment that whenever I need help, with an investee company, I see some gaps there, they will be willing and able to step up and help us out there. But on our own, we are not an island. We can't do it alone. I would say that 60 to 70% of ideas I generate from my fund, that's done internally. But there's not 30 or 40% that I'm very, very lucky to have friends around here, and some of them are sitting here to help me out. One of them is Jarek Jarek, he's the head of small mid caps in RHB, and he's followed me. He was an intern, and he did very, very well over a very short period of time, and he's ranked #1 in terms of small caps. So he comes up with a lot of ideas. I feel very few analysts right now dare to stick their necks out, and I work with people like that. They dare to make a difference. Another guy in sales, Jason, people like that. Like Jason he was with me also in RHB. He was a top-ranked offshore marine analyst, but when he went over to sales, he decided, he can look out for new ideas. And I think recently he told me about companies like AEM. Then I look at it, wow, AEM at that point in time, 90 cents. Then you say, very cheap, goodbye, 5 times. And I look at what has happened over the past month. It went up double. I go, ayo, sayang, what are you going to tell me right now? Then within another month, it's $2. Right? There's just a bonus right now which wants something. So it popped up another double within 2 months. I think that's us. We carry certain baggages and we look at it and we go, yeah, it's gone up so much. There's still a little bit of auntie in me sometimes. But I work with people like that, and don't think that only the financial people, the analysts, the research people can provide me with ideas. I get a lot of ideas from the media themselves. Hao Xiang, he wrote a piece, I still remember vividly, in 2015 November on Jumbo. That analysis piece, I think, is better than most of the analysts out there. So I enjoy reading and doing, and even the bloggers, everybody, I get ideas from all around, and I really, really appreciate it. So this whole ecosystem, I believe, need to be lit up. And it needs to go on fire before liquidity sets in. So this is a little bit of my report card. I did a soft launch in October 2016, which is last year. So these are some of the results. My stock portfolio has been up 17% since inception. Last quarter was fantabulous, right? It did 25%. But I want to stress, past performance, no indication of future, because I do expect some form of healthy correction to set in. So 17 out of the 18 companies currently are in the black. 4 of them are above 20%. 2, I think 1 above between 10 and 20% now, because as we speak, 1 of them popped up to the 20% mark. So 5 of them are above 20%, 1 10 to 20%, 11, the bulk of which I am still trying to accumulate positions. So they're about 11%. 11 of them are below 10%, and 1 of them, I think my smallest position is down 3%. So at the start, I didn't have very much money, not much AUM, so the cost just set in. But I think month on month, my stock cost actually made money, but it's just that unfortunately I think the cost was overbearing. Then at that point in time, I think that we hit the inflection point. We made some right calls, and then it started to pop up. So for the 3 months, between December to March 17th, we are up 13%, but over the last 6 months, it is up 11%. Some of the companies that I sold, and I want to stress again that I'm not a flipper. I always believe what my grandmother tells me. Sik tak xiong che, you sik tak lok che. You know when to board the train, you must know when to alight from the train. Because sometimes the things move so fast, don't be emotional about it. Don't say, hey, I just bought it last week, but it popped up 40%. You don't want to stick to that, right? So I think at some point in time, when it starts to ease, we can go back to the stock. I think my top performer will be Sun Power. It's up 50%. At the point in time, I believe very much in the environmental story in China. It looked really, really sexy. And since the wastewater plays were already in play, so I looked at Sun Power and thought it was nice. And fortuitously, at that point in time, one of the biggest private equity funds in China, CDH, also took a stake in terms of a CB in this particular company. So I was lucky. I lucked out. But everybody can be lucky because the window was very, very open. Even after they announced that they were coming in with a CB, people didn't invest in it. It's sort of like flatlined during that period of time and languished there at 50 over cents. So you could actually accumulate a position after that. I like PE because PE, they do a very, very, very detailed due diligence, and it takes away my headache, especially Chinese companies. So the private equity guys were already in there, and they have done DD on the company itself, and I believe on the management, which is very, very key. So, and that period of time we had, I think, a 2 or 3 weeks window before the company went on fire. And it went, I think from bottom to top is up about 70%. I didn't get all the gains. As it went up, I decided I was going to scale down my position, and after 3 months, I was totally out. Another company, it's probably the second company I invested in when I started the fund, that's Specman, up 42%. I gave away everything, and recently I took a placement. I'll talk about that a little bit later. Jadison, within a month, this guy, I used to cover the company back in 2004. The management is the same guy that's been running this company, and I think that it is seeing a turnaround. So I went into it, but it popped up before I got a very meaningful position. So I was out within a month. And Moya, I think, is interesting because Salims actually cashed up the company very, very early. This company was known as Dayan, but nobody really spoke very much about it. There were a hefty amount of cash, but we met with the management and they were willing to speak. They said that, this money, they have ambitions to actually grow it to a top 2 or 3 player within Jakarta, which if they were to live to their dreams, they would be able to see very, very meaningful profit contribution. So I like that story too. But again, it popped up within a short period of time, and I am partially out of this. Specman, the stock that I still continue to have. When the media came over to meet me before I started my launch, before I launched my fund, I gave 3 stocks. And these 3 stocks, I basically blind off the names, and I explained that these were interesting companies that I will very likely go into. One of them was Specman. This is a movie production house in one of the hottest markets in Asia, if not the world. But at that point in time, it was languishing vis-a-vis another production house, which was MM2. The problem with Specman is that it never made money. It's been losing money year in, year out since listing. And the problem is this guy has 2 production houses. One of them is Liang Ziqiang. The Liang Ziqiang thing make a lot of money. But the other one, that's non-commercial, very arty-farty, like Eric Khoo one, has been losing money every year. So it's been bleeding this company. Then something happened in August, which I thought was very nice because they lopped off, they gangrened this loss-making company. And then that's part 1. Then part 2, we were looking forward to the blockbuster, Master, and that happened too. At all times, they were really trying to build up a talent agency. A talent agency with many different small talent agencies that are pulling it together. And this is touted to be listed in Hong Kong. So there are numerous catalysts. And I believe that this quarter, for the first time in this history of being a listed company, it will be making money. And that is why after selling it off, I went back in for a placement. For you, this must be the most boring company out there. The management also don't inspire confidence. Every time you speak to Elson, he'll say, cannot lah. Things are consolidating. His favorite word is consolidating. And then if you don't know the company well enough, you'll be damn scared of this company. But when I entered at that point in time, 75% of the money or the market cap was in cash. It was a net cash. It was generating cash some more. So I wasn't that worried, and it was dishing out cool dividends. At that point in time when I entered, I had close to 7% yield. I thought the downside was limited because they are plastic manufacturer. Plastics manufacturer, if you have looked at what has been happening over the last few years, they have been consolidating. There has been a fair bit of M&A, and that is why I stake my bets on Fuyu. I know it's going to be a boring company. I'm going to bank on the dividends, and one day, potentially, this guy may be taken out. So it's not too bad to be paid to wait, and it is a solid company. Elson, the management, the guy that's running a company, he's not a spiffy, well-dressed CEO type, He started from the factory floor. So he knows everything about the equipment out there. You ask him about anything, he knows. And I like such companies. AVTech. Remember I mentioned I wanted to invest in 3 companies. I told people at House Young at that point in time, there were 3 companies. I blinded off. One was Fuyu, the other was Specman. The third one is not AVTech. It was AVTech's competitor called Sunright. At the point in time, I said Sunright, they have a lot more cash than its market cap. So it's like sure win type one, but very, very difficult. Very difficult to get a decent position. Then I look at AVTech, competitor, easier to get position. Sure, my upside may not be so generous, but I think, I can I can make do with the kind of like profits that I can make from the company. Sunright was up, for the record, I was up 60%, I think. I mean, from 30 cents when we spoke to about 50 cents. This guy, slightly less, I think I'm up about 30%, but we can build up a sizable position. Burn-in solutions for semiconductor industry, they're riding on this internet boom, the internet of things that I don't really understand, but they are selling and it is getting exciting on that front. And a lot of these manufacturers, if you notice, like Fuyu, AVTech, lots of cash. So I got some form of downside protection. And if you run across the companies that I'm invested in, you see a common DNA. PEC, engineering company, construction maintenance. I lost track of the company for quite a while until I think Jason reminded me about the company. I last saw them, I think in 2012. Things were, like slowing down a little bit. But when I met them, if you want to have some form of exposure within the offshore marine space, the oil and gas, you're riding on oil recovery. If you want to bet on Azure, if you want to bet on companies like Ezion, right? There's still a fair bit of risk. Sure, you can see super returns. It may double up even, treble, possibly. But if you want a safe investment like me, then I'll look for companies like PEC. Cash of 58 cents. When he told me it was like 61 cents. So I'm paying 3 cents for the business. Hardly anything. It comes for free. So, and I met with management. Management, they were quite okay. I mean, they are expecting, inquiries have been very, very strong. The last 2 years, they have not really spoken to a lot of investors. We were one of the first few that they spoke to, and they told us that inquiries are strong. And I believe that given that they are one of the best players and most efficiently run engineering companies within the sector, I believe that they will get a fair share of the order books. So I'm betting on this company. Sing Holdings. This is another very quiet niche developer. CEO is right over there. Zihao, I've known him for many, many years when he first listed. Then he gave me a very good bonus because shortly after he listed, he sold off Ocean Financials in Shanghai, and then everybody got a big, fat dividend. And then they started getting very, very quiet. Then in 2007, I remember they bid the second highest PSF for a plot within Orchard in Cairnhill area. And suddenly, the whole market started to crash. I thought, Sing was jialat liao lah. Cannot survive already. So 2008, it was still, and then suddenly, you remember 2009, there was this small shoebox unit boom. Zihao went back to the drawing board and he decided to downsize, not make it shoebox, but downsize his units within Cairnhill. And he sold superbly well. Everything was sold out versus the other two plots by Capital Land. Next to him, urban resorts, urban suites, they couldn't sell because Liu Man Leong decided to stick on to the plan and make it more human. So urban suites, very difficult to sell, but his Cairnhill sold very well. Recently, I think he made history in Singapore by bidding for by winning a site in Fernvale in Singapore in the slimmest margin possible. We are talking about not $3 per square feet, we are talking about 3 cents per square feet, 3 cents per square feet, I don't know, absolute amount is what, 9,000? 3,000? It's like 3 cents per square feet, it's ridiculous. And the neighboring site by Chip Ing Sing, that one sold out completely, High Park. I believe it is growing, it's a recurring income through hotels. That part is a small part of the business. I think they will still concentrate very much in development work. They're trading currently at less than 0.6 times price to book. I'm not talking about revised book, revalue book. I'm talking about 0.6 times book. And I believe that if the property market were to get an uplift, this guy will follow suit. Except that, there's a lot more room to grow because many of them are already trading at 0.8, 0.85 times. This guy is still below 0.6 times. So I believe that, the upside is there. So with all these, you hear the stories I tell you in the Singapore market. Very exciting. There's 800 more companies out there for us to discover and to look around. There's about, I think, 10 or 13 more that I'm accumulating positions on that I cannot wait to share with you until I have accumulated a decent position. Lots of value in the market. Of course, I would personally watch for a healthy correction. That's when I come in to accumulate more. And the final word is, I think we all need to just work together as a team, to discover all these undervalued stocks in Singapore. Liquidity begets liquidity. That last time question, right? Liquidity begets liquidity. Performance leads to more performance. And I'm confident one day I'll fulfill my dream of reliving 1999. Thanks.
Thanks, Terence. So, I guess you've seen from Terence's presentation, since Azure launch, and in January this year, we are quite lucky. STI has been the best performing market in Asia, but he has outperformed. Small, mid-cap, and selected blue chips, even with the cash drag, has done very well. Terence shared that the ideas that he gets from his funds are from friends, family, etc. And obviously, SGX is here, we are also friends, but we don't share inside information. So, he talked about how you can use screeners on Bloomberg, but Bloomberg very expensive. SGX Stock Facts, you can go and find all the FUIs and all the segments of the world because you just do the screener there, it will also tell you the same thing. So it's free and it's not that difficult. One of the companies he talked about, MM2, is listing off one of his businesses called Unusual in the next couple of weeks. The last Catalyst listing called Kimberly doubled, right? So, I think what's the moral of the story? The moral of the story with this fantastic fund that Terence and all the friends here have gathered to put together is that there are great opportunities. I know we all want to party like it's 1999, right? But in the news flash that he flashed just now, there's a caveat. It says the largest market relative to GDP. So the good news is today, in 2017, Singapore is still the largest market relative to GDP. We just don't feel it, we just don't believe it, we don't know about it ourselves, but it's all right there. So really encouraged that Terence and his friends have put together this great support for the market, and we certainly welcome more investors to come in. There are opportunities, and professionally managed, you get a good result. Thank you. Thank you, Terence.